If you are tired of risking too much money just to make peanuts, you need to master high risk reward trading. So in this video, I'm breaking down step by step how I consistently catch trades with massive risk to reward ratio. So this is part 2. So if you missed the first one where I talk about how to select high probability zones to trade from, make sure you check that out after this. With that said, let's get right into it. Before we get into the strategy, let me quickly explain why is it so important for us to try to aim for high R multiple, high risk to reward ratio trades. Reason is simple, because when you catch high risk to reward trades, it's much more easier for you to become consistently profitable. Here's what I mean. If you only take 1:1 or 1:2 trades, your win rate needs to be like ridiculously high just to make decent returns. Right? For example, if you risk 1:1, you need to win at least 6 out of 10 trades, right? Which, by the way, is incredibly difficult, right? Even professional traders have like a 40% to 50% win rate. And if you take trades with a 1:2 risk to reward ratio, which means you're risking $100 to make $200, guess what? You need 34% win rate just to become profitable, which is still okay, but here's where it gets really interesting. When you aim for trades with a 1:5 risk to reward, which means you are literally risking $100, your risk per trade is still the same, but this time around you are making $500 on each trade, 5 times of what you are risking. And in this case, you only need a 17% win rate to be profitable, which means you can literally lose 8 out of 10 trades. But the 2 trades that you win, you make a shit ton of money back. And here's where it gets even better. With a 1:10 risk to reward, you only need a 10% win rate to be profitable, which means you can literally lose like 9 trades in a row. If you win the next one, guess what? You are in profit, which is insane if you think about it. So this is exactly why we focus on R multiple instead of win rate. Because the average retail trader has probably like a 20% to 50% win rate, which means it's very important for us to try to catch these high risk to reward ratios trades in order for us to, actually be profitable. And most retail traders, they struggle because they are focused on being right rather than maximizing their reward when they are right. Now, in order to catch these high risk to reward trades, you need to trade with precision, which means you need to enter at the perfect timing. And a lot of traders, they enter too early or they chase move, and as a result, they destroy their edge. So here's how to actually refine your entries and make it even better. So let me show you how to refine your entries. In fact, let me walk you through an actual high risk to reward trade that I took recently. This was a textbook setup which made me over 102k, and this was in fact like the biggest trade in my entire trading career. So here's how I did it. As you all know by now, the first step is always to identify a clear directional bias. Right, so in this case, we saw price comes down, pulls back, and then breaks structure to the downside, right? So we have seen that this is our swing high, and then this is our swing low, right? So this is the swing range that we are trading from, and we are obviously in a bearish market structure, which means we want to be selling at supply zones within premium pricing. So in this case, we can easily identify our extreme supply zone that we have right here, and this is a strong zone because it swept available liquidity from this swing high that we have on the left-hand side. Right, so we know that this is an institutional zone that we want to be trading from. And when you go down to a lower time frame, which could be the 15-minute time frame, we can also identify another supply zone that we have right here on extreme. And the reason why this original supply zone is not that strong anymore is because it has already been mitigated, right? What happens is that price came down here, go up there, retest it, fill up the remaining sell orders within the supply zone, and then goes down, right? So it already used all the supply that we have in this original zone, right? So that is where I personally would not care too much about it, and I will only focus on the unmitigated supply zone that we have right here. So the second step is to look for inducements in the continuation phase, right? So in this case right here, we notice that price did not went straight down like this. What happened was that price came down, make a structural pullback, and then goes down even further. Pull back, goes down, pull back, and then go down even further. So inducements are basically all these swing highs that we have on the left hand side during the continuation phase itself, right? So we know that there is available liquidity sitting above this high right here, right? So these are our inducements. So we want to wait for that to be swept. And ideally, we want to wait for price to sweep the inducement that is nearest to the extreme supply zone, right? So in this case, it will be this one right here. I want to see that to be swept, so that we know that smart money has used the available liquidity and is now going to push price to the downside. Okay, so in this case, I could identify all my inducements right here, right? But this one has already been used, right? You can see price just blast right through it, right? So I wouldn't really care about this one. And I know that there is another inducement that is extremely near to our supply zone, right? So I want to see that one to be swept. So that is where I will mark up my inducement line just on the candlestick wick right this, right? At the high of this candlestick wick, and I'll put it all the way up here to the right hand side. Okay, so basically you want to wait for price to sweep the available liquidity above this inducement, right? Tap into the extreme supply zone and then move to the downside. And this is the move that we want to capture, which is why the next step is to set an alert at the inducement line itself, right? So ideally, we want price to close, have the candlestick close above the inducement line, and then that is where we can start looking for our entry. In this case right here, the candlestick did not really close above the inducement line, right? So we can just ignore this move and we'll just be continuously waiting, being very patient until price break above this line. Then that is where we start looking for our entry model. Okay, so right now we pretty much still do nothing until price triggers our alerts, right? So in this case, does it trigger it? Yes, it does. Right, so in this case, it did trigger our alert. This is where I will go onto the charts and then I will start to find my entry model. Remember, the candlestick must close above this push inducement line in order for us to actually enter for the trade itself, right? So at this point of time, I'm analyzing, I'm being very patient because the candlestick has not closed it above it yet. Okay, so at this point of time, our alert has been triggered. That is where I want to find my liquidation candle, right? So this is indeed my liquidation candle because this is the candle that has swept the available liquidity from the inducement in the push phase itself. But remember, you don't want to enter right here immediately. You want to wait for price to mitigate the extreme supply zone so that you can fill up some remaining sell orders. And then that is where we can potentially look for our entry itself, right? So at this point of time, I'll jump down to my lower time frame. It could be the 5 minute for you. And I'll just wait for price to mitigate that extreme supply zone, right? So I won't do anything until it does. All right. So once you mitigate this extreme supply zone, once again, I want to look at price, right? So in this case, this is where you can place your sell stop order below the liquidation candle itself, right? So in this case right here, we have established that this was our liquidation candle and you can place your sell stop order below it if you're entering on a 15-minute time frame, right? So in this case, you wouldn't be tapping the trade because the next candlestick is actually bullish and you will move your sell stop order from here to below this low right here, okay? But if you're entering on a 5-minute time frame, it's like a different story, right? In that case, same thing. You find a liquidation candle, which is this candle right here, and then we know that we should be placing our sell stop order below this low, right? So that's where you place your sell stop order below this low. And if the next candlestick is bullish, just like this, you move your sell stop order from this low to the low of this new candlestick itself. And then if it's like an inside bar candle just like this, which is neither a bullish or bearish candle, you do nothing, right? And then the next candle is a bullish candlestick, same thing, you just move your sell stop order to this new bullish candlestick. And then let's see whether I get them in the trade or not. Okay, so not yet, right? So in this next candle itself, I'll move it right here. And then, do you get them to trade now? There we got tap into trade. Okay, so this is where we should have been tapping into trade. And then that is where I place my stop loss above this candlestick itself. And I'll place my take profit at this nearest 5-minute demand zone, since this is going to be like a very quick scalp. And this will be like a quick little 1:3. 1:3.5 risk to reward, right? Let's see where they go. So price goes down there, tap out, take profit, and then we are out of the trade. Okay, so this is the aggressive version of the entry model itself. Let me show you the conservative version of this entry model. So for the conservative version of the entry model, you basically want to wait for more confirmation before you actually enter for the trade, right? Ideally, you want to wait for some sort of signs that show you that this pullback is over and right now we are shifting bearish. Because in this case right here, if you identify the internal structure, we saw that price is still in an bullish internal order flow, right? So if you enter for a sell right here, we're just assuming that price could potentially pull back to this last internal higher low and continue going up, right? So it must be a very fast scalp if you are using the aggressive version of the entry model itself. And for the conservative version, like I said, you want to wait for signs that tell us that the structure is shifting. This internal order flow is shifting from bullish to bearish, and in that case, we want to wait for this internal high low to get taken out. Once the internal high low get taken out, we know that there is a shift in structure, and right now price is shifting bearish and we're going to create lower highs and lower lows. So let me show you how to actually use the conservative version, right? And ideally, depending on the type of trader you are, you can choose one that works for you. Okay, so in this case, if you go down to the 5-minute time frame, and you can see that right here, the internal structure is what? Creating higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, right? So we can establish that this is the most nearest internal higher low, right? So ideally, we want to see price take out that last internal higher low. How do I know that this is the most recent higher low? Because this is the most recent internal break of structure, right? So we want to see that get taken out. Once that get taken out, that is where we got our confirmation that price is potentially shifting bearish, which means we're not doing anything until price take out that low, right? So over here, I'm not doing anything, not really interested in what price does. You can see price continue going up. I don't care, right? So in this case, what happened is that price actually went up there, swept more liquidity, right? It swept the liquidity above this swing high that we have right here. And now we can potentially start to anticipate that a strong move is coming very, very soon, right? Since it swept the available liquidity above the inducement during the pullback phase as well, right? So in this case, we finally got our market shift where price actually broke the last internal higher low. When this happens, this is where you can start looking for your entry. So you basically want to identify the point of interest that led to this market shift itself, right? So in this case, I can identify that this right here is the 15-minute supply zone that led to the market shift itself, right? So that is where you can potentially place your sell order at the edge of the supply zone itself, and then you place your stop loss above the supply zone, and you can potentially target, let's say like this high right here, this low right here, just for demonstration purposes, right? Let's see where to get them to trade. Boom, this is where you get them to trade right here. Now get them to trade. Let's see what happens next. Okay, boom, price just have an absolute meltdown just like this. Very, very simple. And you have placed your stop loss above the supply zone, right? So that will be like a quick 1:5 risk to reward trade. And this right here is actually the trade that I took. This is actually the one that made me over 102k, right? And honestly, I did not enter right here the minute price mitigate the extreme supply zone. I was a little bit late. I entered somewhere right around here. And then honestly, I got really lucky on this trade. CPI news came out and it caused price to absolutely collapse. And I placed my take profit at the edge of like this zone that we have right here on the left hand side, this 15-minute supply zone right here. Once again, guys, please do not trade the news, right? Because the news is prone to a lot of market manipulation. And the only reason why I held on to this trade is because I was already in the position before the news come out, right? So before the news, I actually moved my stop loss like below this last high, lower high right here. So if the news does not go in my way, guess what? I will still be able to protect my downside. I get stopped out with just a small loss. But in this case, yeah, price did went in my way, so you can call me lucky. Alright, so if you still don't get it, don't worry. Let me show you a bullish example. Right, so in this case, we got a bullish break of structure. So we have identified that we're in a bullish trend direction. And we see that this right here is our extreme demand zone. And we also saw that this is actually indeed a very strong demand zone because price actually swept available liquidity below these swing lows right here. And then demand step into the market and cause price to push up, right? So at this point of time, I'm waiting for price to pull back to this point of interest. But remember, the step 2 is to look for inducements during the push phase, during the continuation phase. So in this case, we saw that price did not go up straight like this. If price goes up straight like this, then we know that there is no push inducement. Then we can expect the zone to fail, right? But in this case, price actually went up, pulls back, goes up, pulls back, goes up, pulls back, and then goes up even higher itself, right? So we know that there's available liquidity below this low, so on and so forth. But remember, the most important inducement in the continuation phase that I want to see get swept is the one that is nearest to the extreme zone itself, which is this one right here, right? So you can see this is where I will draw my inducement line, right? So this is the line that I want to see to get swept, right? So that is where I will place an alert at this inducement line right here, and I wouldn't do anything until my alert get triggered. Okay, so in this case, I'm just patiently waiting, not doing anything until price step into my demand zone and actually trigger this inducement line right here. Right, so let's just wait and see what price does next. Okay, nothing. Boom. All right, so it's approaching our point of interest, right? That is where I can start to go down to your 15-minute or even the 1-hour time frame to start looking for your entry. As you can see right now, price is approaching our inducement line, right? So that is where I'll potentially go down to the 15-minute time frame, and that is where I can start looking and observe what price does, right? So you go down even further. All right, cool. Do we Does our alert get triggered? There we go, right? So our alert got triggered right here. But remember, we only want to enter when the candlestick close below the liquidation. So in this case right here, does the candlestick close below the liquidity line? No, it doesn't. It creates like a wick break and then goes back up. So it doesn't count whatsoever, right? So I'm still waiting for my candlestick to close. There we go, right? So the minute the candlestick closed just like this, right? You can see it right here. The candlestick has closed below. You can jump down to your 5-minute time frame, your lower time frame, and that is where you look for the liquidation candle itself, right? So in this case, TradingView does not allow me to do so. So I'm just gonna enter on the 15-minute time frame itself. So that is where I'll identify my liquidation candle, which is this candlestick right here, and I'll place my buy stop order above the liquidation candle itself, right? So let's just go back one more. Right here, place your buy stop order above the liquidation candle, place a stop loss below the liquidation candle itself, and potentially let's just try to target like this 15-minute demand zone right here. Okay, just for demonstration purposes. But I myself, if I want to place a take profit, I'll probably place it at like the nearest 15-minute zone right here. This is the nearest 15-minute internal high low right here. You know what, let's try to target this 15-minute internal high low. Okay, so let's see what price does. Okay, price goes up. Do we smash our TP or nah? This would be like a more of like a intraday to swing trade already. Okay, do we get our TP smash? There we go. There we go, baby. So yeah, this was a pretty simple 1:6.7 risk to reward trade. And the reason why we actually placed our TP right here is because this was that internal lower high, which we are expecting price to pull back to. And this is also a supply zone that swept liquidity from these highs right here. Right, so quick little bread and butter 1:6 risk to reward trade. So that's the aggressive version, but what about the conservative version? How would I have entered this trade if I were deploying the conservative version of this entry model? That is where, let's go back, right? Remember, I want to wait for a market shift after price has swept the push inducement, the inducement that we have on the continuation phase itself, right? So the minute price has swept that low right here and trigger our liquidity line, I don't care, right? I only care after I got a market shift. So in this case, where is the most nearest lower high? It will be this one right here. Okay, this is the nearest lower high because this is the one that led to the last internal break of structure to the downside, which is why I want to see that high get taken out before I start looking for my entry, right? So that is where right here, I'm not entering yet. I'm not caring about what price does. And then once that actually happens, this is our market shift, which tells us that right now, price could potentially shift bullish, right? The order flow is shift bullish, and it's potentially going to pull back to this internal lower high that we have right here, right? So I'm looking to catch this move right here. So after you got your market shift, that is where you can look for the point of interest that led to this market shift itself, right? So you can see that this is the extreme zone. Okay, this is our extreme demand zone. And we also have a flip zone that we have right here. Alright, if you are not sure what is flip zone, please watch part 1 of this video itself. And we have identified that this is a flip zone because it caused this supply zone to fail, and then we got a failed reaction. Right, so at this point of time, got a market shift. This is where we are waiting for price to pull back to either one of our point of interest, and then that is where we got our entry right here. But I want you to observe what happens next. Alright, okay, so in this case, price consolidate around here, does not, okay, tap into our flip zone right here. But let's go back a little bit. Look at what happened. Okay, I don't want to show you like a perfect textbook example. I want to show you what the market actually does. In this case, what do we have? We have available liquidity below this low right here, right? How do I know that there is available liquidity below this low? Because what happens is that price went up, pulls back, goes up, pulls back, and then goes up, right? So in this case, that is clear as the equal lows, right? So we know that retail traders who enter for a buy right here, they're going to be placing their stop loss below this low, right? That is why price actually did not respect this flip zone, right? Price actually blast right through it, sweep the low right here, and then go. That is why I personally, I have a mechanical rule which states that I either enter on the extreme zone or I enter on a flip zone that sweep liquidity, right? So in this case, this is not a flip zone that swept liquidity, because a flip zone that swept liquidity, it looks something like this, right? Where it swept the liquidity and then we get the move. And we know that this is the high probability zone, and then you can wait for price to pull back to that zone and you can look for your entry, right? So in this case, I personally would not have entered for this trade if I'm using this particular entry model itself, right? So yeah, but if you want, what you can potentially do is that same thing, you can wait for price to sweep those lows, right? And you identify the liquidation candle itself, which will be this candle right here, and then you just place your buy stop order right above it, just like that. Very, very simple. Or actually above this bearish candlestick, because that's the inside bar candle, and that is where you could tap into the trade and then potentially TP at this 15-minute supply as well. Okay, so that's pretty much the entire entry strategy to catch high RR trades. Obviously, there's a lot of nuances to it, and I cover a lot of this stuff more in depth inside the 1% Club. So if you are looking for direct mentorship and you're looking for my entire proven mechanical trade plan, you can click the link in the description and try to apply for my mentorship. With that said, if you want to learn how to master trading in 2025, make sure to check out this video right here. And as always, remember you're just one trade away.